In that last line, the lower quality credit starting to rally, underscoring the durability of this market right now and the rally we've had. Your thoughts?
This is what we talked about last month. High yield managers they're in a quandary. Last year was kind of free money. It was only the second time, 2005 being the other time, where high yield did well and triple C's didn't lead. It was double B's. You didn't have to take risk to get returns. And now you just do the math and realize that with double B's kind of yielding less than 4% today, right? That's not where you're going to get your returns. The only way to get them is through triple C's. However, most of the triple C's, or a lot of where the yield in the triple C's are in the energy space, where I think investors realize that a lot of these companies, even in the best of times, don't generate a lot of free cash flow. However, since we don't know where the price of oil is going to go, or at least rational people don't think they know where the price of oil is going to go, all right, who knows? What if we go to 80? These companies will be okay, at least for a while. So they're chasing things. And that's working so far. It's working in the short term. But the reality is that a lot of these companies, they don't work at $50 or $60 oil in the E&P space. And you're going to see a lot of restructurings unless we continue to see the price of the commodities climb.
You seem quite skeptical of the rally that we've had. We're back to the tights I don't think we've seen since 2014. The parallels between now and then, was that a stronger setup, technically speaking, the backdrop, the dispersion? What did that look like compared to what we have right now?
Yeah, the dispersion was a lot less. So what was generating that yield, you could get that yield without taking on an excessive amount of risk. In order to get the index yield today of closing in on 5%, you have to take a lot of risk. If you're not willing to buy a lot of those E&P companies and some of the other kind of distressed credits, you're talking about getting 4%. Back then, even if you avoided some of that kind of cuspy stuff, you could have gotten close to that 5%. That's just not the case today.
George, your take?
I think that the framework, like we talked about for the fixed income market, it's pretty strong from a technical perspective, right? You have roughly $500 billion less in supply that's going to be coming out this year, right? So from a global markets perspective, you see that. But I think specifically to high yield, what you're seeing there is a liquidity challenge, right? The liquidity challenge that we had back in September with the repo market coincided exactly when triple C started gapping out. And now all of a sudden they're figuring that out and triple C spreads are coming down. So they moved from 8.5% up to 10, and now they're back to 8.5%. Again, for us, it's not truly underlying fundamentals that are improving. It's just some of these technical factors. And I think over the long haul, that's going to be a tough thing for them to work through.
Priya.
Just from a macro standpoint, I would say, I would completely agree. I think fundamentals are telling you that there should be more dispersion. I think we should be looking at the credit of these companies a lot more. But you look at how tight these spreads are, and that just tells me reach for yield is dominating everything else. The fact that there aren't even enough treasuries, people are looking for yield elsewhere. But I just worry the first sign of either default risk picking up, downgrades picking up, I think it makes certain sectors of the credit market extremely vulnerable. So either you have to be smart and get out early, or you have to hedge that with duration.
This theme that there's not enough debt, does that carry over to some of the dynamics we're seeing in Europe at the moment, where we've had a record week of issuance, but there's a belief that we'll be starved of that supply as the year grows older? Is that a dynamic you're thinking about, Priya?
Yes, it is, because particularly for Europe, the ECB is doing QE, so they are taking paper out of the market, and on a net basis, the numbers are not that high in terms of net issuance. So I think this global reach for safe bonds, or even not so safe but high positive yielding bonds, I think is still out there.
George?
But it's the other side of the equation too, right? So it's not only the supply is down, but the demand is up dramatically, right? The demand for corporate debt domestically here, the demand for even munis was record year last year of inflows, and you're seeing that across. And I think that's the thing that you're going to see right now actually play out as institutions start getting demand, right? You're getting a lot of pensions and you're getting a lot of pensions moving into the point where they have to move from their equity exposure, that the gains that they've had, into fixed income. So you're going to see flows that way. Individuals 65 plus, we're seeing flows in that way. So from a both supply standpoint and a demand standpoint, it's really favoring moving into fixed
What's the
income
biggest driver of those inflows we've seen into high-grade credit funds in the United States? A record week of inflows. What's the biggest driver behind that?
It's a combination of the institutional side, but the individual side, I'm telling you, 65 plus, it's talking about 1.3 trillion a year for the next 10 years is going to be flowing from individuals in that. And we're definitely hearing that from our clients right now, starving for income.
Gershon?
This is why active management is here to stay in fixed income. We're just great at chasing what the theme was in a previous period that we were dead wrong on. So 3 months ago, no one would touch an energy bond. Now people can't get enough of it. 6 months ago or 9 months ago, the story was, oh my God, triple Bs, they're all going to get downgraded. We won't touch those. Now people can't get enough of them. So there are opportunities to go against the grain. That's what we try and do. We don't always do it 100% successfully, but that's what active management does in fixed income. As it relates to IG, People are somewhat chasing it. People do need yield. The one thing that we're hearing from our clients outside the United States, you talk to, both European investors and especially Japanese investors, the cost to hedge has come down somewhat. It still is somewhat costly relative to history, but since the Fed has cut a number of times now, the cost to hedge back to the home currency, whether it's the euro or the yen, has come down. It is making a lot of investors have been on the sidelines for the past 2 or 3 years. They're starting to come back a little bit.
I want to pick up one point that you made just to wrap up this conversation. Going against the grain. What is going against the grain in 2020? What's the contrarian call within fixed income, within credit at the moment? What is that trade? As you said, coming into 2019, everybody hated this triple B story, especially those of us who were outside of fixed income looking in, saying that looks like a scary place, fantastic year. What is the triple Bs of 2020?
Well, I think one is chasing the weaker E&P credits, we think is a very big mistake. Now, how can we be wrong on that? If oil goes to 80 or 85, we'll be wrong on that. But again, that's not something. That's some probability
like loans?
We can't.
What about leveraged loans?
Well, I think leveraged loans actually looks more interesting to us than they have been in quite some time. As we've, for 10 years we were negative on it. We actually have more exposure in our portfolios today than we've had in some time. I wouldn't say it's the greatest opportunities in sliced bread, but some better opportunities than we've seen.